Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is James Emanuel, a London-based private investor and founder of Rock & Turner, known for finding extraordinary value in overlooked markets while others chase trendy stocks. A former lawyer turned contrarian investor, James has built a reputation for discovering fundamentally misunderstood companies, trading at a massive discount, sharing his research thought in his popular Substack, newsletter, and book, Fabric of Success. James, how are you? So nice to see you.
I'm really good. Thank you for having me on, Bogumil. I always listen to your podcast, and I'm delighted to be on it today.
Well, I told you that I absolutely loved your book, and I really enjoy your writing. I'll mention for the benefit of the audience, the book is full of stories about businesses that we're familiar with, but the book gives you a whole different perspective on different twists and turns of how these businesses came about, how they became successful, and how close they were actually in many cases to failing. But before we get there, I want to ask you about you. And you might know that I kick off those conversations with the early days, if you allow me, and I ask my guests about their childhood upbringing. And how do you think that time shaped you, specifically your relationship with money and the career path that you chose?
Well, I'm not sure my childhood and upbringing shaped me at all. And this is kind of a classic debate of nature versus nurture. So I have two siblings, a brother and a sister, and we share the same genetics. And we had the same childhood and upbringing, but we couldn't be more different in terms of character, temperament, and the way that we see the world. So it may be more pertinent to explore my personality traits because that's really what shaped me and my relationship with money and my chosen career path. So let me kind of lead you through that a little. So first, I take nothing at face value. I question absolutely everything, which drives people mad, but there you go. It's an intellectual curiosity that I find absent in the vast majority of other people. So, think about this, different religions. So in Christianity and Islam, the prevailing belief is that we live once, we're judged, and then we face either eternal reward or damnation. And if you contrast that to Hinduism and Buddhism, their beliefs are that the souls are reborn in new bodies until achieving enlightenment and liberation. And these views are logically incompatible. Is the reincarnation idea correct, or is the one life and judgment model correct? Of course, both could be entirely wrong, but both can't be true. Now, let me ask you this. How many people born into any of these faiths have ever questioned this? They just accept what they've been told at face value, and they conform to tradition. And that's fine. That's their prerogative, but not for me. And so from a very young age, I used to raise this kind of question all the time. I always used to ask why? And I probably drove my parents mad. And they once said to me, are you disappointed that we don't have all the answers? And I said, no. I'm not disappointed you don't have the answers. I'm disappointed you don't have the questions. And that's kind of the intellectual curiosity. And that tendency to question everything is invaluable as an investor. But that's the first thing that's probably shaped me. Secondly, I'm fiercely competitive. And I like to do well at everything I do, which doesn't mean that I'm great at everything. I just focus on what I'm good at. So when I was younger, soccer and athletics were my sports, and I won a lot of trophies and medals as a child, and I captained the teams that I played for. But I wasn't really good at cricket or basketball, and so I simply avoided them. And I guess that's what Buffett would probably call a circle of competence kind of thing. And then finally, there's this kind of perception of value, which I've always had. So let me tell you this funny story. I call it the Rolex story. So after graduating in law and completing my professional qualifications, I decided that a career in law wasn't for me. Lawyers mostly deal with other people's problems and they're constantly fighting or litigating, as they call it. And that's a lot of negative energy. And it
Mm.
perhaps explains why people in the legal profession have one of the highest divorce rates. I love the academic side of law and it trained me to think in a very structured way. But as a career, it wasn't for me. So my father had been a gilt broker. That's UK government bonds for anyone not familiar with the terminology. So I grew up around talk of finance and markets. And at school, I was always really strong in math and economics. So I decided to enter the world of finance and banking. And the trading floor was full of young, brash, ambitious people. It was a little like a scene in The Wolf of Wall Street back then. It's changed somewhat now. Anyway, I received my first bonus and I knew exactly what I wanted. I wanted a Rolex watch. And the funny thing is that without discussing it, the guy that sat next to me had exactly the same idea. And he came to the office the next day and he was so proud and he rolled up his shirt sleeve and he showed off his watch to everybody in the office. And he very brashly declared what he'd paid for it. He was kind of proud of how expensive it had been. But he wasn't quite so happy when I showed him that I'd bought exactly the same model watch, but I'd paid significantly lower price. Now, you probably know that Rolex don't allow dealers to cut deals, but when you network well enough, anything's possible. So I always look for value in everything I do, and that's something that lives with me even today when I'm investing. But the kind of Rolex story doesn't end there. You know, my brother, I told you he was very different to me, and he lectured me that it wasn't necessary to pay thousands for a Swiss watch when a couple of hundred would buy you a very reliable Japanese watch. But I saw things differently, and it kind of reminds me of that Patek Philippe advert. You don't own a Patek Philippe, you look after it for future generations. What a great slogan that is. Anyway, I told him his Japanese watch was entirely utilitarian, while mine was a savvy investment. And needless to say, 25 years later, my Rolex is worth probably about 3 times what I paid for it back then, while his Japanese watch died and was kind of consigned to the graveyard years ago, and it's been replaced multiple times. So, you know, as Buffett always says, price is what you pay, but value is what you get. They aren't the same thing. So, you know, that's a really long-winded answer, but hopefully you get an idea of my personality traits and why I'm perhaps so well suited to investing.
So many things to touch on, and I don't know where to start. I'm going to start with the price and value. The idea that you wanted to have a luxury watch, an expensive watch, but you didn't want to pay for it. I think it's very symbolic, and it's going to come up in this conversation as you're looking for quality businesses and you are very conscious of how much you pay for it, which could undermine the success of the investment if you overpay. And that's one thing. The second thing is questioning what you hear. I can really relate to that, and I find it's just part of me. When people tell me something, obviously, if it's small, we don't have to argue about it. But if it's something more important, especially if it's a strong opinion, especially if it has something to do with business or investing, I want to see the source. I want to see who said it. How was it exactly explained? I want to dig a bit deeper. And I do want to mention the fact you brought up Patek. I manage money for families, multi-generational family fortunes. And I feel like the fortunes that I'm responsible for, they're here not just for the benefit of this generation, just like that watch, but also for the next and the one after. And the fact that this fortune is even here, it's because of the previous generations that made some decisions. So I'm curious if we're going to explore this throughout this conversation. I do want to bring up the fact that you decided to be a lawyer, then you changed your mind. There are quite a few people that I know that went to the legal profession first, including Charlie Munger, and decided to be investors. What that experience taught you, getting a law degree, and how did it help you to become a better investor?
Well, law teaches you to be a very kind of analytical thinker. You have to break everything down. And you kind of dissect it into different parts. And you don't just look at the argument in favor of whatever case you're supporting. You also have to consider the arguments that will be made in the case against you, which is, again, very, very useful when it comes to investing. A lot of people will buy into a narrative. And they'll kind of follow that narrative through, and confirmation bias sets in, and that's all they think about. And they don't think about, well, what might go wrong. I always think about Howard Marks. He says, if you look after the downside, the upside will kind of look after itself. And being a lawyer really helps you in that regard, because you're always looking at what might be thrown up, what could go wrong, what are the counter arguments.
Fascinating for me, and I see how many lawyers have been really successful investors. I'm curious about your influences, some of the books and thinkers that influence your investment philosophy. And I'm guessing you brought up some names already, but who else? Who has really made a big difference in your life and inspired you to be the investor that you are?
Well, I've already spoken about my intellectual curiosity, and that leads me in all sorts of different directions. And life requires a multidisciplinary approach. Lessons learned in one field have a great value when applied in another. And I think Charlie Munger said, I couldn't stand reaching for a small idea in my own discipline when there was a big idea right over the fence in somebody else's discipline. And that's so true. And I kind of live my life along the same line. So I've read countless autobiographies, and they're not all business based. Some may be sports coaches and that type of thing, but mostly it's entrepreneurs. And I find these inspirational and full of thought-provoking ideas. And it isn't about copying what others have done. It's about learning how they respond to various situations, creating, as Charlie Munger would say, mental models, and ultimately about pattern recognition, because that's where the value lies. So, reading all these books, what I found really fascinating over the years is this concept of convergence. So try this for multidiscipline thinking. So a shark and a dolphin are very, very similar in shape and color and design. But here's the thing. One's a fish and the other's a mammal. So they've both evolved down entirely different evolutionary paths, but converged by ending in roughly the same place. So, what does that tell us? It tells us that evolution is a process of trial and error, survival of the fittest, and it yields the optimal design to suit any given environment. So I took this idea and looked for convergence in the business world. When successful people across different eras in different industries and located in different parts of the world all achieve great success by evolving their business operations in such a way that they all converge on a remarkably similar approach, it's worth sitting up and taking notice. And I call these similarities golden threads. And this topic inspired me to write a book, which you mentioned earlier. It's called The Fabric of Success, with a kind of subheading, The Golden Threads Running Through the Tapestry of Every Great Business, which captures the essence of the book. So now when I invest, I always look for these golden threads in companies before investing.
On that note, a big part of your book is about people that are running businesses. And it was really striking to me how you make a point that in some industries that from outside look like they're not attractive, too much competition, the margins are too low, the customer loyalty is not there. You have a manager that comes in, a CEO or a founder, that somehow is able to turn that not so attractive industry into an attractive opportunity for one individual business. I don't think I've seen it presented that way before anywhere else. Can you talk about that? How much a person running a business can change a challenging industry into a great opportunity?
I've always said that people are the most important thing. That's probably the most important factor and often overlooked. There's so many pieces of investment analysis I've read that don't mention the founder, the owner, the CEO. And as they say, the jockey is more important than the horse. So a case study I always use is Apple. So it was founded by Steve Jobs in the 1970s. It nearly crashed and burned under the leadership of John Sculley, who took it to within 90 days of bankruptcy in the 1990s. And then it became one of the most successful companies of all time following the return of Steve Jobs. Now, Apple was always the same company with the same addressable market and the same industry. The only difference was the person steering the ship, and the outcome couldn't have been more different. The most important thing for an investor to understand is that the same company with a different leader is no longer the same company. And this kind of proves it. So, leadership drives outcomes, and the cost of investing in the wrong people can be huge. Now, consider this. After being fired from Apple in the early 1980s, Steve Jobs founded the software business Next, which eventually became the Apple operating system. He was also instrumental in the success of the animation studio Pixar. And later in his career, when Pixar was acquired by Disney, he became Disney's largest individual shareholder. He joined the board, and he helped transform that company's fortunes. He influenced its strategy, and he played a key role in the appointment of Bob Iger, another exceptional CEO. So the takeaway here is that if you'd been able to invest in everything that Steve Jobs touched, you would have done very, very well. And as investors, we're not necessarily looking for the next Apple. We're looking for the next Steve Jobs. And how many investors think this way? In my experience, very few do. But the smart ones, they really get it. So, let me tell you about one of them. So you're probably familiar with the name Henry Singleton. He was the man that Buffett described as probably the best capital allocator ever. He had an extraordinary track record at the helm of Teledyne. But very few people know that Singleton was a very early investor in Apple. Now, personal computers were in their infancy. They were truly new technology back then, but hundreds of computer OEM startups appeared out of nowhere. Unsurprisingly, very few of them succeeded. Most kind of withered and died. So Singleton was later asked, how was it that you chose to invest in Apple, which emerged as a clear winner? And he said that Steve Jobs, even at a really young age, had impressed him. And Singleton described him as a man on a mission who was putting everything on the line to achieve his vision. And that distinguished him from all of the others. And it's the reason that Singleton invested. And of course, as we know, with the benefit of hindsight, he picked the winner. So, in answer to your question, it's all about the people. The people are more important than the business.
Can I pull on that thread a little bit more? You talk also about the succession at Apple, because Steve Jobs is no longer with us, and it's such an important topic also for the families I work with, but for so many businesses where you have an incredible CEO. I'm thinking even of Berkshire Hathaway most recently, where Warren decided to retire. Having a business set up and framework that allows this business to continue past that visionary CEO, founder, it's not as easy, and there are more stories of failure or flatlining after that. What can you do, what those businesses could do? Apple continued to succeed after Steve Jobs. Is there a formula? Is there a golden thread in there that allows some businesses to continue and succeed past the original founder?
Oh, absolutely, there are. This is one of the golden threads that I touch on in my book. There are different types of CEO, and there are serial CEOs, as I call them, who jump from company to company every 4 years. The average tenure for a CEO in the US is, I think, 4.2 years. But it tells you something about his incentives. He'd be interested in building his own wealth, but not yours. He'll be driven by short-term results to meet perhaps badly defined targets so that he qualifies for bonuses, even if those, if meeting those targets are to the detriment of the long-term prospects of the company and its shareholders. So, as an investor, every time the CEO changes, you're effectively being required to roll the dice on the outcome. And, who wants that? So, if you want to be invested for the long term in a company, you're holding a stock for 10 years perhaps, and the CEO is changing every 4 years, that's 3 CEOs you're going to see through your 10-year holding. Anything can happen in that time. That's a huge risk. So what you need is corporate culture that values continuity. And that's critically important. It's one of the golden threads that I pull on. So, high quality long-term CEOs are always the best, and succession planning is kind of equally important. So just think about Jeff Bezos at Amazon. He served 25 years, give or take, as the CEO. Then he handed over to Andy Jassy, who had worked alongside Bezos for much of that quarter of a century. And that's the way to do it, promotion from within. Think about another great company, Novo Nordisk, the Danish drug company that produces diabetes and weight loss medication. That's been around for over a century. And believe it or not, over that entire 103 years, I think it's been around, it's only ever had 5 CEOs in all that time. And each one of those is promoted from within. Costco is another great example. It's had 4 or 5 CEOs in the last 50 years. And they've all worked their way up from relatively menial entry-level jobs. So you can see how these golden threads exist in all these great companies. But they don't exist in isolation. So decentralization is another golden thread that appears again and again. So, think about this. When a company starts out, the founder is easily able to manage its small operation. But as it grows, if one person wants to micromanage every part of the business, he'll spread himself really, really thin. And he doesn't have the time or capacity to manage everything in a large corporation. So not wanting to relinquish control, if it's a control freak, he codifies operations and he manages through proxies, particularly process as a proxy. And that's when bureaucracy creeps in. It's like a virus that slowly damages the business. So the CEO will eventually retire, and an external hire is typically made in those cases to replace him. And that person then comes in and inherits all of these processes and procedures with no understanding of why they were implemented in the first place. And the whole organization ties itself in knots, and it becomes a management bureaucracy. And no employee should ever excuse poor performance by simply stating, well, I followed the process. But this is effectively what happens. They won't get fired for following the process, but they may lose their job if they act like a maverick. So all innovation and entrepreneurialism within the workforce is stifled, and everyone becomes kind of a de facto robot. You're left asking, do you own the process or does the process own you? And I've worked for large tier 1 banks. I've worked at Citigroup, I've worked at Deutsche Bank, I've worked at Nomura Investment Bank. And this is exactly how they work and why their businesses are mediocre at best. It happens everywhere. And that's kind of exemplified here. We've got an American, German, and Japanese bank. And because they've grown in this way, this bureaucracy kind of creeps in. But the best companies quash this bureaucracy. They remain nimble. They empower people. But most companies don't do it that way, which is really unfortunate. So if you want to know why I call bureaucracy a corporate virus, think about this. Think about this from a perspective of an employee. So a person's earnings are shaped not only by their skill, expertise, and passion, but also by the quality of the business they work for. So, a talented person employed at a bureaucratic company is limited in what they're able to achieve. And so they're likely to move on and to pursue better opportunities elsewhere. So the company is left with only mediocre employees at best. And that results in further declines in performance, making it even more difficult to attract top talent in the future. And this is how the virus eats away at the company from the inside. So, the way to solve this problem is to achieve excellence through decentralization, which is another key golden thread, hiring and nurturing talent, and then allowing them to do their own thing. I think it was Steve Jobs once said, you can hire brilliant people. He said you can't hire brilliant people and tell them what to do. He said at Apple, we hire smart people so they can tell us what to do. You have to hire brilliant people and get out of their way. That was his mindset. He said, we don't hire people to do a job. We hire people to do great things. And the best people in the world are the ones who make everyone else around them better. He said, we don't hire people to fit in. We hire people to challenge us and make us better. That's a great way of thinking about things. And it explains why Apple achieved so much. And it takes a special type of CEO to kind of think that way. Now, you think about all of the other CEOs who have embraced decentralization. You've got Warren Buffett at Berkshire Hathaway. You've got Mark Leonard at Constellation Software, Prem Watsa at Fairfax Financial, Bruce Flatt at Brookfield Corporation, Richard Branson at the Virgin Group. We've already spoken about Jeff Bezos at Amazon. And we've just mentioned Steve Jobs at Apple. Now, it's no coincidence that these are all hugely successful and all operate in the same way. It's a thoughtful approach to leadership, and it brings us back to the convergence I mentioned earlier. It optimizes efficiency, it minimizes key person risk, and key to the question you asked me earlier is it makes succession planning so much easier. If you've got decentralization, you empower people develop within the company, and then when it comes the time for the CEO to step down, you've got a lot of other capable people who can step in. I remember Bill Gates at Microsoft, he used to deliberately take between 2 or 4 weeks off every year, and I think he called it reading time. And he instructed the office not to contact him under any circumstances. And essentially, what he wanted to do is to test whether key person risk was removed, whether the business could operate without him. And that's essentially the same thing. So there you go. We've got another company, a great company, which operates in a similar way. We've got that convergence coming back. So it becomes clear how all of these things, long-term thinking, long-tenured CEOs, nurturing talent, promoting people from within the business, decentralization, and absence of bureaucracy, they're all interrelated. So these golden threads don't operate in isolation. They're all interrelated. And this is how the golden threads, in my mind, interweave into what I call the fabric of success, which is, no surprise, the name of my book. So, we all know that true wealth is created by compounding over long periods. And as Phil Fisher used to say, buy a great company and hold it forever. So if you're investing in a company for the long term, you need to make damn sure that these golden threads are present. And they won't appear on a stock screener. And this is why qualitative analysis is so much more important than the quant stuff. Leave the screeners for the amateurs to play with.
It's a fascinating point because a lot of investment research is based on screens. We think that we can look at 10 metrics or 3 metrics and find the winner. And I really like that point that you touched on, that it's much harder to find a business and identify the qualities that you listed just now from a screen, even if you know the metrics.
Yeah, well, here's the thing. Just on that point, before we move on, the statutory financial reports and accounting standards were never designed with investors in mind. Many of the standards are questionable at best, and they really paint a distorted picture. So, the requirement to publish accounts was initially to aid in tax collection, but also to enable creditors to assess how robust a limited liability company is before lending to it. So, a simple decision like whether I expense my costs as OPEX or capitalize them as CAPEX makes a huge difference to my earnings numbers. And, it doesn't matter that every aspect of the business will be the same. My earnings numbers will appear to be very different. So on that basis, what use is any metric that uses raw earnings numbers? None at all. But how many people fixate on price earnings ratio on some kind of a screener? And then, there are other accounting standards relating to capitalized leases, unrealized revenue from mark-to-market valuations, which Buffett always complains about, asset write-downs, equity method accounting. These all distort published numbers and make them really unreliable. And then you've got all the discretion around numbers. Over how many years do you want to depreciate your capital assets? Do you carry non-depreciating assets at cost or replacement value? Companies have so much latitude in the way that they choose to account that it renders the statutory accounts almost useless to investors. So, as an investor, I need to make adjustments to normalize these distortions. And it's one of the reasons Buffett calculates what he calls his owner earnings, because only then can we accurately get a picture of the true unit economics of the business. But stock screeners don't do any of that. They just work off raw, unadjusted numbers. The old saying, garbage in, garbage out. And that's exactly what you get with most of these screeners. And, there's a really interesting story here. So you're probably familiar with the name John Malone. He was the legendary CEO at TCI. And he served from 1973, I think, for a quarter of a century. And it's really important to understand that the prevailing trend among public companies at that time was to focus on the optimization of net earnings. And to be perfectly honest, that mindset continues today. But Malone recognized that this approach was fundamentally flawed. He understood that paying taxes on earnings drained capital that could otherwise be reinvested in the business. So he focused on minimizing, not maximizing, minimizing net earnings through heavy growth spending. And he also liked to use debt because the interest payments were tax deductible. So, he was focused on minimizing tax obligations on liabilities. And so his earnings always looked really unimpressive. And that confused Wall Street, which is always, as I said, fixated on earnings multiples. So Malone tried to educate them. And rather than focus on meaningless bottom line numbers, he urged the analysts to focus on his company's true earning power, which was its ability to generate cash before capitalized spending and before interest expenses, which led to the introduction of EBITDA as a metric. John Malone created that specifically for this purpose. Before then, there was no EBITDA. Anyway, TCI had what looked like really meager earnings, and that caused its price earnings ratio to appear exceptionally high. And many investors avoided it on that basis, which was foolish because over Malone's 25-year tenure, TCI became a 900-bagger investment, which is incredible. And really interestingly, Jeff Bezos adopted a very similar approach at Amazon. And investors have continually and still to this day complained that its earnings multiple is way too high, leading many to have missed out on what was one of the best investment opportunities of the 21st century. And so I suppose the one thing we learn from history is that people don't learn from history. So back to your question, the problem with these stock screeners is that investing is an art, not a science, but too many people try to distill it down to quantifiable mathematical formulae. And that simply doesn't work. Torture the data for long enough and it will tell you whatever you want to hear. But the qualitative stuff never lies. And that's so important. It's so important to remember that. And that's why stock screeners, in my opinion, should be treated with a great deal of caution. The only way to invest is to do the hard work that so many others are either unable or unwilling to do.
No, I think it's brilliant, and screens became such a big part of the investment community's life, and I've used them in the past, and I know how imperfect they are, and I know how much more work is needed to actually understand how the business functions and succeeds. I want to ask you about the underlying current that's happening in a successful business, and I would boil it down, and you talk about it, the ability to reinvest capital at high rates back into the business. I mean, ideally indefinitely, right?
That's the goal.
That's the goal. Tell me about that, because it's something that came up on this podcast quite a few times, but I feel like it's not talked about enough. As you said, we're focusing on earnings per share and other metrics. Nobody's actually looking at the ability of the business to reinvest the cash they're generating back into the business at still respectable and hopefully improving rates. Tell me about that.
Sure. Well, as I've already said, there's no magic formula for identifying these great businesses. So we've already established that stock screeners aren't particularly helpful. And we've also looked at how important it is to identify the golden threads, as I call them, that are present in all of these great businesses. And also we're focused on the importance of management. But beyond all of that, there are probably 5 key things that I look for in a company. So the first is it needs to be durable. So I ask myself, can I see this business still operating strongly 10, 20, or even 50 years from now? So, for a company like Coca-Cola, for instance, that's quite easy to answer with a strong degree of conviction. It's survived for 150 years and will probably be around for another 150. And that's what they call the Lindy effect. But I also ask myself, what would happen if the company disappeared? So imagine a company like Microsoft. And Microsoft, so if Microsoft's products ceased to exist, so there was no Windows, there was no Office, all of them disappear overnight. Almost every other business around the world relies on Microsoft software and its operating system. So they would all be on their knees. The world would be severely disrupted. And there aren't many businesses like that, but durable companies have strong brands, essential products or services, significant market share, and they usually operate in an industry with high barriers to entry. So having durability reduces the risk of obsolescence and disruption, and it certainly helps to ensure that an investment can compound over decades. So that's number one. Number 2 requirement on my list is that it needs to be predictable, generating regular, consistent returns. So stable revenue streams, recurring customer relationships, stable costs, and a track record of steady profitability. These are all good metrics for measuring this. Predictable businesses are far easier to manage and to grow, and this supports long-term wealth building. Number 3, I'd say, is resilience. So the business needs to be able to withstand market downturns, economic shocks, and to adapt to changing industry conditions. This means typically a strong balance sheet, prudent management, diversified revenue sources. You don't want any concentration amongst customers, and the ability to pivot when needed. 4th, I'd say, is sustainability. And I'm not talking about that in an environmental sense. I'm talking about economics. So the company needs to be able to fund its operations and growth organically without relying on external capital. It needs to be able to survive and thrive independently. Which means it's less vulnerable to credit cycles or capital market disruptions. And finally, it needs to be scalable, which means being able to grow revenues without sacrificing margin. And at a very high level, this is how I tend to identify interesting companies, which I think may end up being long-term compounders. And then, of course, it becomes a question of price and opportunity cost. Is it better than what I already have in my portfolio?
When I'm listening to you, I'm thinking of the incremental business. And let's say we have a billion-dollar company, the additional 100 million of revenue. Very few people want to ask at what margin does it come and what returns does it come, right? We just want to see the top line go up and maybe the earnings per share go up, but nobody's asking if that incremental business is as good as the existing one or maybe better. And some businesses are built to make the incremental million or 100 million of revenue better than the original, the scale and so on. They can benefit from it, but not necessarily. There are some businesses that have an incredible business, great margins, but all the additional revenue, they're reaching for places and opportunities that offer lower margins. We're not paying attention to it as much, but I think it's really interesting how the quality actually diminishes if you.
Oh, you're absolutely right. A lot of management will focus on growth at what I call any cost. So, a perfect example, I suppose, is Brooks, the running shoes that are now part of the Berkshire Hathaway empire. So, that grew and expanded, and it was growth at any cost. And unfortunately, the marginal returns on incremental capital deteriorated to the point that they were lower than the incremental cost of capital, which made no sense at all. And so I can't remember the guy's name, but they brought in a new CEO, and he cut the company back to the bone. So he cut out all of the loss-making parts of the business, and he went back to fundamentals and basics. And I think he reduced at the time revenue from 60 million down to about 50. It was coming in at good margins. And from that, he grew the business up to what is now, I think, one of the premier running shoe brands. And as I say, it's since been acquired by Berkshire Hathaway, which speaks to its quality. And so sometimes, less is more.
Yet another story of an individual coming in and turning around a business in an industry that's not an easy to operate in. We have a handful of those ideas. We found them. We're building a portfolio. I know you have some thoughts about portfolio concentration. How do you think about it?
Great question. When I started out in investing, I was like a child in a candy store. So, I saw so many things that looked good that I wanted one of those, one of those, one of those. And before long, I had this huge portfolio, which may be good for diversification, but it isn't the way to invest if the objective is to build wealth. First, the buy and hold strategy is by far the best because you compound gross rather than net, and the frictional transaction costs and taxes associated with trading are avoided, and they're best avoided as much as possible. So, this makes more of a difference to long-term results than most people appreciate. So, back in the 1950s, the average holding period for corporate stocks was over 8 years. Today, believe it or not, it's about 5 months. People simply don't hold. They have no patience. They buy and sell all the time. It's almost as if the act of trading is what drives the results, which of course isn't the case. And the fortunes of any business don't change very much in the course of 5 months. So clearly, if people are only holding stocks for 5 months, they're not looking to make gains against improvements in the fundamentals of the business. Instead, they treat equities more like a lottery ticket than a stake in kind of a tangible operating enterprise. So if you're seeking to trade as little as possible, a huge diverse portfolio is the last thing you want. So, that's the first thing. Second, there are very few good quality businesses that you would really want to hold for the long term. So when you find one, it's important to make a large commitment and to hold on. And the whole secret of investment is to find places where it's safe and wise not to diversify. And that was something else that Charlie Munger used to speak about. Diversification, as he said, is protection against ignorance. And it makes no sense if you know what you're doing. So I don't know if you're familiar or you've ever read the work of Professor Bessenbinder, but he conducted some really interesting analysis looking all the way back to 1926. I think that was as far back as he could find reliable data. But it was almost a century worth of data. And he found that over time, only 4% of listed companies were accountable for pretty much all of the wealth creation. And more than half of companies over that time period didn't even outperform treasury bills. So you can forget about equity risk premium. So you need to find this small number of exceptional companies and effectively ride the wave of their success for as long as you possibly can, which goes back to the Phil Fisher mantra, the best time to sell is never when you've got a good company. So once again, this leads to conclude that a very concentrated portfolio is the way to go. So, Charlie Munger again used to ask, why would you allocate capital to your 20th best idea when you can simply add to your top 3 positions? And this always makes me think of Nick Sleep. I don't know if you're familiar with that name, but he achieved excellent results running the Nomad Investment Partnership. And he was really heavily invested in 3 companies, Amazon, Costco, and Berkshire Hathaway. And when questioned about this concentration, he said, and it was quite amusing, he said that he never found a 4th company good enough to warrant reallocation of capital from the other 3. And, that kind of sums up exactly what Munger was saying. So all that to say that I no longer act like a child in a candy store, and instead I'm really concentrated. I swing hard if I find something that meets my investment criteria and demonstrates the golden threads that we discussed earlier. And, to maintain a concentration, a key part of my investment discipline is that if I want to open a new position, then something else has to go. And this is something new that I introduced a number of years ago, but it forces me to think about opportunity cost. And it helps the portfolio evolve to become ever stronger over time. It's kind of a survival of the fittest, if you like. But, let me just say this for anyone listening. If you aren't confident in swinging hard, then at least be patient. And the concentration will look after itself. So, let me give you a really wild example. So imagine you decided to invest in Amazon at its 1997 IPO, and you decided to take a 3% position. And the rest of your money you put in the S&P 500. So now you're effectively diversified across 501 companies. Amazon wasn't in the S&P 500 back then. And then you do nothing for the next 28 years. No tinkering, no rebalancing, no trading. You just sit on your hands and do nothing. Yeah. That tiny 3% Amazon allocation would have grown so much that now it will make up over 93% of your portfolio. And meanwhile, the investment in the S&P 500 would have effectively shrunk to less than 7%. So what started as a diverse portfolio would have become super concentrated with no effort on your part. So, those are my thoughts on portfolio concentration. Patience is really the key. So I hope that helps.
I took so many notes, and I'm going to just mention a handful of things. I got to meet Nick Sleep in Chris Begg's class at Columbia. Chris teaches the original security analysis class, and I really enjoyed hearing his thoughts. Many things about his work, and his letters are public, so this audience can explore and read. And people have talked about on podcasts about Nick's work, and William Green in Richer Wiser Happier talks about Nick's work. But to me, the fact that he traveled the whole world looking for opportunities, including Asia and different parts of the world, and he ended up holding major U.S. companies that had this open-ended runway, a global runway. It's really fascinating. I'm sure there's a thought there too and a lesson. I want to bring up Howard Marks, who I believe said that, there are 2 people. One is buying the stock at 10, sells it at 11, buys it at 15, sells it at 16, and on and on. And the other one buys it at 10 and holds it until 30 or never sells. Which one do you want to be? I think the answer is obvious, listening to you. If you bought the right thing at the right time, why sell it? But between the two of us, I think it's the hardest thing that I had to embrace over the last 20 years of managing money, actually not doing anything and waiting. I had Chris Mayer on the show who talks about the 100 beggars, and he says, the drawdowns are tough, but the dead money periods are the hardest. Even the most successful businesses had 5, 7, 10 years of the stock going absolutely nowhere.
Yeah. Well, no, go ahead. Sorry, I didn't mean to interrupt.
Just even the Magnificent Seven had periods like that. We forgot about that, right? To hold on through that period, it's really tough.
It is really difficult. Amazon's a great example. It IPO'd at 18, it shot up to 106, and then the dot-com bust came and it fell down to 6, and then it climbed back up again, and then we had the great financial crisis and it dropped back down to 50, and so 12 years of volatility. But if you've got faith in the company, then as you say, I think you should ignore the noise of the market, and have faith. Imagine that the market's closed for 10 years, as again Buffett likes to say, and his very famous 20 hole punch card. I think this is a great way to operate. But on this topic, there's another way of thinking about this as well, in terms of compounding. And you're talking about Hal Marks, and the example I always give, which helps to deliver clarity, is you probably heard this story that if you start with a penny, after 30 days, it's worth 5.3 million if it doubles every day. Right. Now, the really important part of that is that on the 30th day, you've made 50% of your returns. And on the final 2 days, you've made 75% of your returns. And so, compounding is all about holding in, because it's at the end that you get your biggest returns. Now, on that point, one other thing. Imagine you had two people that start with this penny and it doubles every day. And they're both held on for 29 days. One of them decides to sell on the 29th day. And on the same day, he invests in something else, which is also able to double on that last 30th day. The problem is, he's got transaction costs, which aren't going to be huge, but he is liable to a capital gains tax on the gain he made on that 29th day. So the amount he reinvests on the 30th day is much smaller than the guy who just hung on to the company he'd invested in the first instant. And the difference that makes is substantial. You're talking about millions. The guy who holds on is up to about 5.3 million. I think the guy who sells and then gets back into something else on the 29th day, I haven't got the numbers in front of me. I did run it once. I think his final result is about 3.6 million. And so, just by tinkering with the portfolio, it really does eat into your return significantly. And it's not until you run the numbers you realize how significant that actually is.
You touch on compounding, and I feel like our minds are meant to work in a linear way, 1 + 1. And exponential growth that compounding is just escapes our imagination. And there are those stories. I think Morgan Housel talked about Buffett creating 90 or 95% of his wealth after the age of 70, 75, I don't remember. But it's staggering, because Buffett was rich when he was 35 and he was very rich when he was 55. But to think that he still had not had 97, 98% of what he has today by the age of 75 or 70, it's hard to imagine and embrace. But that's the reality that you're explaining. Compounding is a back-ended experience. You're going to get the most at the end of whatever time period you're considering. But
if you don't interrupt it.
Exactly. But it feels like watching paint dry for a long period of time, and then it starts to kick in.
Sometimes it is, although, there is a counter-argument to this. So, Buffett invested in Coca-Cola in the late 80s, and it had a fantastic run in the years that followed. So I think he invested around 88. And the next 12 years, it rallied really strongly, and it peaked around about the year 2000. And it was trading for 50, 60 times earnings. And I think, he has lamented the fact that he didn't sell back then. He didn't. He held it. And the share price fell back. And of course, I think he still holds it today. And if you work out the CAGR that he would have achieved in the first 12 years compared to the CAGR he has achieved now, it's significantly different. So it doesn't always pay to hold. Microsoft is another fantastic example. It peaked in the year 2000. And if anybody was holding it back then, that's a great time to sell. Again, all of them call it. And it actually took 15 years for the share price to recover to its 2000 peak, even though in those 15 years, revenues continued to compound, I think, at double-digit levels, earnings continued to compound at double-digit levels. But because the price was it had run so far ahead of fundamentals, it was a dead 15 years for investors. And so I guess this goes to that famous saying, price really matters. Doesn't matter how good the underlying business is, price really matters.
There are moments when it's very tempting to exit an individual stock, and maybe even the whole market. The second hardest thing that I can think of in my professional life that I'm still embracing and learning is going back once you sell out of an idea, or if you trim out of the market, going back. And I've done it, and I went back to the same idea multiple times on some occasions, trying to practice what you described. It's harder than it seems, because those stocks don't necessarily actually get cheaper and give you a second chance to re-enter. And somehow psychologically, it's so difficult to go back to an idea that you walked away from.
That's so true. Although having said that, some companies, as strange as this may sound, some companies are cheaper as the price goes up.
Hmm.
And what do I mean by that? Well, investing is first and foremost about risk-adjusted returns.
Hmm.
And so if the risk has reduced, but the price is slightly higher, you might find that it's a better entry point. And, a wonderful example is a pharmaceutical company. So they may have got an approval on a drug they've been running through testing for the last 10 years. And they get the approval, which reduces the risk significantly, but the price jumps. It might be worth getting in at that higher price because now they've got the approval, they can start selling that drug, and that's when the real returns will start to compound. And so it's quite important, I suppose, to detach yourself from the price in isolation and to think about risk-adjusted returns.
Now, I like that idea, and I'll emphasize for the benefit of the audience, when we say risk here, we don't mean price volatility, we mean actual loss, the business going south, right? Mm-hmm. But it's very true that the business got bigger, we know more, maybe they have more approvals, and some of the risks that were present 5-10 years ago are no longer present, so you have to take that into account. James, I want to ask you about finding those leaders we talked about. You mentioned quite a few traits we're looking for. Is there a way for us to identify those folks before they achieve something that's on the cover of a magazine?
Well, it isn't easy. Sometimes a person's brilliance only manifests partway through their journey. Other times there are clues from the outset. So think about the inaugural shareholder letter of Jeff Bezos in Amazon's first year back in 1997. For anyone that's listening that hasn't read it, I would urge you to do so because it really is exceptional. So, in that letter, Bezos explains that it's all about the long term. If everything you do needs to work on a 3-year time horizon, then you're competing against a lot of other people. But if you're willing to invest on a 7-year time horizon, you're now competing against a fraction of those people because very few companies are willing to do that. And so just by lengthening the time horizon, you can engage in endeavors that you could never do otherwise. And so that puts you at a huge competitive advantage. And this is one of the things he explained in that first letter. So, he's pointing out that he's got this long-term time horizon, this long-term perspective. And he also explained that, when forced to choose between optimizing the appearance of GAAP accounting numbers, quarterly earnings, and maximizing the present value of future cash flows, he'll always take the cash flows. And so what he was essentially doing was managing the expectations of his investors. And at that point, if they agreed with his long-term approach, then they were welcome to come along for the ride. But if not, there were plenty of other companies that they can invest in. And Bezos was essentially reading between the lines. This is what he was kind of saying. And it reminds me of something else that Charlie Munger used to say. He used to say a company gets the investors that it deserves. And Bezos, certainly didn't want the wrong kind of investors, and that was clear from the outset. He never ever pandered to the wants and needs of investors. And to demonstrate that, he always refused to pay a dividend. He never paid a dividend, favouring reinvestment of earnings. What does that remind you of? We spoke about John Malone earlier. And it's a topic that I feel really, really strongly about. My mantra, which I repeat over and over, is that it's all about optimizing the return on capital, not the return of capital. But most CEOs get this asked backwards. That's another Munger phrase. And maybe we can come back to this kind of topic later of dividends. But all of this to say that the clues were all in that inaugural shareholder letter for Amazon. You could have picked them up in 97 as soon as it had IPO'd. It's so important to understand the way that a CEO thinks. And every great CEO, in my experience, will always seek to communicate his thoughts to his shareholders. So, just think about Mark Leonard at Constellation Software. Again, Buffett at Berkshire, his shareholder letter is wonderful. Bruce Flatt at Brookfield Corporation. Prem Watsa at Fairfax Capital. I could go on, but I think you get the general idea. They've all achieved greatness, and they've all very eloquently articulated their thoughts in their shareholder communication. So again, we've got this kind of convergence of approach. But returning to Amazon, you didn't even need to have picked up on the clues at the IPO at the beginning of the journey, because I think I mentioned it earlier, despite the business being really great with exceptional leadership, its share price had a real roller coaster ride over its first 12 years. So, you had the dot-com boom and bust, and then you had other challenges before the great financial crisis. And then, by 2009, 12 years after the IPO, the share price was in the bargain bucket. And that was even though both of the primary engines were in operation. So, we could see e-commerce was highly successful, and web services had been up and running for 3 years. So most of the real gains for Amazon happened after that. So investors had 12 years to understand both the business and its exceptional leader, but many still missed it. Even though it wasn't just the inaugural letter in 97, every single year, every letter that Bezos has written has been exceptional. And on the flip side, there are CEOs who don't communicate very well. They see shareholders as an inconvenience. They award themselves huge salaries and bonuses, and they treat the company as a cash cow to fund their own lavish lifestyles. Stock-based compensation is exploited to the full. That's another bugbear of mine. Perhaps we can speak about that later. And they're only interested in meeting the next quarterly guidance. And how can anyone expect a favourable outcome when you invest in those kind of people? Let me give you a great case study. So Twitter was the right product launched at the right time. It went viral when social media was taking off, and it offered a really differentiated service to that offered by other social media platforms. So Facebook was all about interacting with friends and family, people that you knew. But Twitter was different. It was almost a modern day town square where strangers with common interests could meet and debate and discuss and learn and advance their thinking. And its popularity exploded, as we all know, and it should have created great wealth for its investors, but it didn't. The IPO happened in 2013, and the IPO price was about $45. And a decade later, the company was taken private, as we all know, by Elon Musk, who's now renamed it X. And it was taken private at pretty much the same $45 per share. So accounting for a decade of inflation, shareholders experienced a loss of purchasing power. They were never paid a dividend because the company never issued a dividend. And so it was truly an awful investment. Now, it may or may not surprise you to hear that while investors lost money in real terms over that decade, Jack Dorsey, its CEO and the brains behind Twitter, took his personal wealth from pretty much zero to $4.5 billion. And so, that gives you an idea why investors didn't actually achieve very much. It was all going out the back door. So, the clues were there all along. Investors could see the way that Twitter was being run and the kind of management it had. Huge amounts of stock-based compensation being paid to insiders. It amounted to a wealth transfer from external shareholders to insiders. But investors acquiesced, more for them, and they arguably got what they deserved. So, once again, be sure to invest in the right people and watch their conduct very, very carefully.
I actually attended Twitter's IPO lunch during their roadshow.
Wow.
And I never invested in it. I don't think Dorsey was actually there. And if he was there, he wasn't really very vocal. Somebody else was running the business. He was in operations.
Right.
I'm forgetting his name. But I just didn't walk away with a good feeling how this business can work. As much as it has created a lot of value for the users, I think it was very hard to monetize it. Maybe eventually somehow someone will. But it's a separate story. You touched on the two sides of the equation. You have the shareholder. Whenever I come back from Omaha, I mention in my letters how Buffett puts us shareholders on the pedestal. Even with the announcement of his retirement, we found out about it right after his kids. I think it's very symbolic. Not all businesses operate that way. And I want to touch on stock-based compensation. You have strong feelings about it. It became the way of compensating executives and employees. In some cases, I see that half of the net profit goes to stock-based compensation, which is staggering. What are your thoughts about it? Is this I like the idea of people becoming shareholders in the business where they work. I would be more open to the idea that they do it with their own money instead of...
Yeah, I mean, you speak about half of the profit going in stock-based comp. In 2021, Palantir paid 120% of top-line revenue as stock-based comp. Think about that for a minute. Okay. So this really is a bugbear of mine. So stock-based comp began as a practical solution for cash-strapped startups. So it's the classic sweat equity, where employees accept shares instead of cash because the company simply can't afford to pay competitive salaries. So, that's fair enough. That makes a lot of sense. But what started as a survival mechanism for fledgling businesses had morphed into something entirely different. And in my humble opinion, it's deeply problematic. So rather than being sweat equity paid in lieu of cash salary, it's now mostly cream on top of remuneration. And those remuneration packages are already more than generous. So, there are companies that quite literally print money, such as Google and Apple, and they sit on huge piles of cash. And yet they pay away tens of billions in stock-based compensation every year. Why? Why do they do it? Companies will tell you that stock-based comp aligns employee and shareholder interests, but that's just not true. So, think about this. External investors supply capital because they believe in the company's future. So they expect both capital appreciation and income along the way and are happy to stay invested for the long term. But employees receiving stock-based comp typically view it as salary that's temporarily been locked up. And so they're normally really anxious to sell at the first opportunity. So, on the one side, we have reluctant owners anxious to sell. And on the other side, we've got willing long-term investors on the other side. So, is that alignment? I don't think so. It's simply a wealth transfer mechanism, and it transfers wealth from external investors to insiders. And these companies know it's wrong, which is why the vast majority of them exclude stock-based comp from their adjusted earnings, pretending it's not a real cost. And as Buffett says, if employee remuneration isn't a cost, then what the hell is it? And then there's the issue of repurchases to offset dilution.
Sure.
So these offset trades occur at the time of vesting, not at the time of granting. They occur typically years after the grants are typically made, and when the share price is far, far higher. So the company is buying high from the market and selling low to insiders. Isn't that the opposite of what any intelligent investor would do? And worse still, the buybacks happen as a matter of course to offset dilution with absolutely no regard to whether or not the company is being overvalued by the market. And repurchasing shares above intrinsic value destroys shareholder equity, which is why, the likes of Buffett never do it. They'll only buy opportunistically if the intrinsic value dips below, or if the share price dips below intrinsic value. And of course, these companies that are repurchasing to offset dilution would dress up the buybacks as something that's beneficial for shareholders, which indicates one or two things to me. Either management is completely inept or they're dishonest. But for an investor, neither is a good thing. Um, and worse still, all of this artificial demand for the shares created by this buyback behavior inflates an already stretched valuation. It pushes the share price further and further away from fundamentals, causing market distortions and bubbles. And there was a really interesting piece of Deutsche Bank research which showed that from the period 2009 to 2019, companies buying back their own shares to offset dilution spent $4 trillion. That demand simply wouldn't have existed in the market. So, it's artificial demand, $4 trillion of demand. What do you think that does to price? So, let me tell you how bad this is. Between 2022 and 2024, both the top line revenue and earnings at Apple fell. But during the same time period, its share price doubled because it spent about $262 billion of corporate capital repurchasing shares, mostly to offset dilution. These companies have blown the efficient market hypothesis clean out of the water. I mentioned Palantir earlier. That's another serial abuser of stock-based comp. Look at the fundamentals of that company and then look at the share price. You won't be able to reconcile the two. And if you've ever wondered how its share price is so overinflated, now you know. And this brings me back to another problem in stock-based comp. The true cost is only known many years later when the grants vest and repurchases are executed at the prevailing market price. So investors find themselves in a really difficult situation because corporate costs are not properly being disclosed in the financial reports. And so it makes a mockery of corporate accounting. So, valuing a company that engages in this kind of behavior becomes almost impossible because you don't know its labor cost. One of its largest input costs is completely opaque. So it's why I avoid abusers of stock-based comp, which takes many of the leading tech firms off my menu. But, I'm happy with that. One of the problems we've got, I think, is that Pandora's box has now been opened. So these tech companies, why they started it, I don't know. Maybe it was a way of applying golden handcuffs to employees because, of course, if another tech company wants to poach their staff, they have to buy them out of all of these grants that they're waiting to vest, which becomes really quite expensive. Maybe that's the reason, maybe it's not. But these tech companies certainly compete for skilled labor based on how much stock-based comp they can offer. And because it's not an immediate cash cost, it's completely spiraled out of control. So essentially, these companies may have dug themselves so deep into a hole that they can't find a way to dig themselves back out. And this is the very kind of systemic issue that the regulators are supposed to address. But as usual, they're asleep at the wheel. And where it all ends, I have no idea. But do I want to be invested in a company that destroys shareholder equity in this way and overinflates its share price? I don't think so, because sooner or later it's going to end badly. There's this weak argument about stock-based comp motivating employees, and I would argue that it distracts employees because it encourages them to focus on the share price rather than on building the company. From the end of 2021 to the end of 2022, employees at Tesla saw the value of their stock options collapse by nearly 70%. Now, remember, they've already paid tax on those grants. So how do you think that made them feel? Do you think it motivated them? I don't think so.
No.
There are so many arguments I can make against stock-based comp. I've just scratched the surface. I dedicate an entire chapter of my book to the topic. But I find the best managed companies choose to do it differently. Berkshire Hathaway is a perfect example, and that's another golden thread. So, if you're interested in digging deeper, grab a copy of the book.
There's so much more in the book, but it's a fascinating topic. It's a phenomenon, and so many ways to approach it. I don't know when it's going to go away, if it's going to go away. I feel like those companies have a challenge of attracting talent without offering some sort of stock-based compensation. And then as a shareholder, I'm in a tricky position because I do want to have exposure to those businesses. Then I'd like the stock prices to go up. But if they do go up, then that hidden cost will be even higher. It's a very tricky place to be when you're evaluating, analyzing a business.
Well, listen, Google has been ranked one of the top places to work in the world. They put a lot of effort and thought into providing benefits for their staff, and people are happy there. You just look at Glassdoor; people are really happy. Not only that, they're working with very, very high caliber people, so they can learn from each other. People want that environment as well. It's not just about the stock-based comp, and the salaries they pay are pretty substantial. And so, I think the stock-based comp thing is entirely unnecessary. But as I said, for me, it's corrupt and it's a means of lining the pockets of the senior staff, and is why I think you have so many billionaires now walking around, particularly in Silicon Valley. It's obscene. It's egregious.
I want to ask you about the other way of returning capital. We talked about buybacks, dividends. It looks like there was a point when dividends mattered. I hear those stories of families living off of dividends. And there are fewer dividends. The dividends are smaller. I know there are parts of the world where people live off dividends of publicly traded companies. In the US and in Europe, especially in the US, it's less the case. Tell me about the dividends. Can they come back? Will they go up? Why aren't they higher? Why aren't the yields higher?
Well, this is interesting on so many levels. So, the US market has always outperformed the UK market, and it trades on higher multiples. Now, some people have put that down to the fact that there's more liquidity in the US, but frankly, it's something else. So, McKinsey did a study, and they discovered that in the UK, payout ratios are so much higher, and the playbook that most UK companies follow requires progressive dividends, and so what they're effectively doing is giving away their ability to grow. The fuel, the capital fuels growth, and if they're giving that away, they're going to grow more slowly. And if they grow more slowly, then they're going to command a lower earnings multiple. But dividends generally is an issue on which I have some really, really strong views, and it's been the cause of some heated debates with other investors. And not everyone shares my views, but let me try and explain the way I see things. So Richard Branson took his company Virgin public in 1986, and then he privatized it 2 years later. Why did he do that? Well, he grew really frustrated by short-termism of investor thinking, particularly, and this is key, attitudes towards dividends. So he had no intention to simply follow tradition and to pay dividends as a matter of course. To him, the payment of a dividend meant a loss of capital to the business, which of course it is. And he once commented that shareholders had entrusted their money to Virgin in order for the management of the company to help it grow, not to hand 5% of it back on a silver platter every year. And for me, Branson really nailed it. So think about it this way. When winding down a company, after all the liabilities have been settled, surplus cash has been distributed to shareholders. And that's effectively what we call liquidation. Now, think about a dividend. It's a distribution of surplus cash to shareholders. So, what is it? It's a de facto partial liquidation of the business. Now, why would you partially liquidate a wonderful company? Surely it's better to optimize growth through maximum reinvestment, as Bezos did, as John Malone did, as Warren Buffett did. So, if there's no immediate opportunity to reinvest the capital, then build a war chest. Isn't that exactly what Buffett has always done? And it's always worked well for him because it's enabled him to swoop on opportunities during downturns when others find themselves strapped for cash. And that's probably the reason he's currently sitting on about 340 billion in cash today. And, as I said earlier, when speaking about Jeff Bezos, being a great CEO is about optimizing the return on capital, not the return of capital, which again, goes back to the heart of why I don't like dividends. So, once again, we've got a golden thread appearing here. So we've got Jeff Bezos, Warren Buffett, Richard Branson. They all view dividends as a poor way to allocate capital. And they aren't alone. Henry Singleton was exactly the same. And Mark Leonard at Constellation also came around to this way of thinking. So, once again, I mentioned convergence at the beginning of this discussion. And here we have it again. Enormously successful CEOs all doing something the same way. They can't all be wrong. So, Singleton always liked to point out that dividends are really tax inefficient. And they're tax inefficient because they're paid out of taxed corporate income. Yes. And then they're taxed the second time as income when received by the investor. So who wants double tax jeopardy when that money could be reinvested in the company, gross, and then compound on the company's balance sheet? And it gets worse. So do you know how many companies pay out dividends and then turn to the debt and equity markets to replace that capital that they've just given away so that they can reinvest it in the business? Look at the cash flow statement. Look at the cash flows from financing, and you see it all of the time. Debt issuance is almost exactly the same as the dividends they're paying. It's equivalent to borrowing money simply to pay out dividends. Really? Whoever thought that was a good idea? So, if I were the CEO of a company and my CFO proposed this kind of thing to me, I'd show him the door and his feet wouldn't even touch the floor on the way out. But it happens all the time. People invest in companies being run like this, and I don't understand why they invest in companies being run like this. Just think about the math. So if a company has the ability to generate 20% return on invested capital in perpetuity, and it reinvests all of that 20% back into the business, then all else being equal, the business will compound in value at 20%. But if it decides to pay out half of its earnings as a dividend, reinvesting only the other half, then the rate at which the business compounds will also be slashed in half. So it grows at just 10%. It's simple math, right? And if you want a real world example, look at McDonald's. It pays out most of its earnings as dividends. Its payout ratio is ridiculous, 80, 85, 90%. And it's seen almost no growth in the last 15 years. So it started to look more like a high yielding bond than a growth equity. But it's worse than a bond because it doesn't benefit from the seniority afforded to bondholders in terms of recovery. So, who wants that? So, this is why if I see a company which boasts about having a progressive dividend policy or being a dividend aristocrat, then for me, that's a huge red flag. It means that dividends are being prioritized over all else, which tells me the CEO is a poor capital allocator, which isn't what I want. Why would any competent corporate manager tie his hands and commit to the least favorable form of capital allocation with no way of knowing what other opportunities are likely to present themselves in the future? Good management navigates one day at a time and keeps all of the options open. So, capital allocation is all about opportunity cost. And in my mind, it flows like a waterfall. So, I keep saying it, and I'll make no apology for saying it again, because it really is so important. Running a successful enterprise is about the return on capital, not the return of capital. So, let's look at this waterfall through that lens. So the first priority ought to be accretive investment in growth, or building a war chest for future investment. And both, if done properly, are purely about optimizing return on capital. Next is the paying down of debt. And any opportunity, people don't see it this way, but any opportunity to reduce equity financing through accretive share repurchases. For me, share repurchases aren't about returning capital to shareholders, as they're often dressed up to be. It's about reducing equity financing. There are two forms of financing a company. You've got the debt and the equity. And equity financing is by far the most expensive, because you're effectively giving beneficial interests to equity holders, so they become entitled to distributions of any earnings that you decide to make over the course of the life of the company. But not only that, they're entitled to a share in any capital appreciation in the company, which is something that can't be quantified until a later date. Whereas debt, on the other hand, you've got a fixed repayment schedule, and interest payments are relatively low. And so what you want to do, most CEOs will be quite keen to pay down debt, but they don't apply their mind to paying down the more expensive equity financing. So you've got this waterfall. So you've got reinvestment in capital and building a war chest. Next tier down is repayment of debt and repayment of equity financing. And then only after all of those other options have been exhausted should the company think about return of capital in the form of dividends. That's the last resort. So some companies, for instance, those in declining industries, tobacco, for instance, maybe oil, coal, they find themselves at the bottom of the waterfall. There's no sense in reinvesting in growth, because there is no growth in those industries. It's all about milking the asset now through the decline, and you can make some good returns on those. And they can justify a partial liquidation of their business, because essentially they are winding down. So dividends aren't always bad, don't get me wrong, but they need to be applied in certain instances. But for a growth company in a growth industry, dividends make absolutely no sense at all. So to sum up my thoughts on dividends, if a company pays dividends, you need to ask yourself this: is this a sunset industry? Is this a company with no other capital allocation options, in which case do I want to be invested in it? Is this a company with management that doesn't quite grasp the nuances of good capital allocation, in which case I probably don't want to be invested in it? So the answers to all of these questions ought to help inform your investment decisions. And for me, most of the companies I invest in, they tend not to pay dividends, or they pay very little in the way of dividends.
I think it's beautifully put, and it emphasizes what we talked about throughout this conversation. You want a business that's able to reinvest back in the business at decent returns, and hopefully improving returns. If they don't have those opportunities, think twice, and dividends might be a sign of it, and high payout ratios might be a sign of it. James, I could keep you here all day. I have one big overarching question. How do you think about success?
This is it, Bogumil. Not everyone is invited onto the Bogumil Baranowski podcast, right? I've made it. This is what success looks like. No. On a serious note, let's take this question outside the realm of investing, and let me leave you with kind of a philosophical thought. Success. What's the meaning of life? For me, it's very simple. It's procreation. It's passing on our genetic code to the next generation and playing our part in evolution and ultimately the survival of our species. Nothing else really matters. That's our purpose. Everything else we do is just filling time, which we try to do in a way that makes us happy, but it doesn't really matter. So on the basis that I have a wonderful family and 3 beautiful children, I guess you could say, mission accomplished. So for me, that's what success looks like.
I love it. Nothing to add. James, this was such a wonderful conversation. I learned a lot. There's so much more in the book. There's so much more in your Substack. You're sharing so much. And you have a way of seeing things that's different. And you get to the bottom of it. And I appreciate your honesty and no fluff, just the way you think, just the way you operate, and just the way you pick businesses. And I think it's very refreshing. I think more businesses could benefit from your thoughts in terms of how they manage their affairs, how they think about capital allocation. And hopefully some of the things we are disappointed with these days, short-term thinking, stock-based compensation, eventually will be removed from the universe, and better practices will prevail, the ones that we talked about throughout this conversation. James,
absolutely.
Thank you
So thanks for having me on. It's been great fun.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money.